Companies are racing to reduce their debt loads and avoid defaulting on their bonds, and they're doing it by taking advantage of the stock market's rally. Monica Bertrand is here to explain that trend. Monica?
Well, Scarlett, public companies are selling record amounts of equity to pay back a bond and other loans, and they're cashing in on the S&P 500's 40% gain since early March. As you mentioned, more than 165 companies raised a record $87 billion in secondary share sales this quarter, and 77% of them used those proceeds to slash their debt. Here are a couple of examples. You had Ford, this only company, automaker that hasn't filed for bankruptcy. It sold $1.6 billion of stock last month, so it could get the cash to pay for a retiree medical fund. Also, you had MGM Mirage. It issued $1.1 billion of stock to repay debt. That helps fuel a rally in its bonds. And with all these second share sales, companies are essentially choosing to dilute existing stock rather than defaulting on their debt payments. Now, Christopher Garman, he's chief executive officer over at debt research firm Garman Research. He says by focusing on credit quality, companies are putting bondholders ahead of shareholders for the first time since 2003. Companies piled on debt in 2006 and 2007 to repurchase stock and boost their shareholder returns when borrowing costs were at an all-time low. Scarlett?
Monica Bertrand.